Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Welcome back to the Risk Intel podcast. I am thrilled to have Tyler Pihl with me today. Tyler is responsible for enterprise risk at Service Credit Union and is returning to the podcast with us after a great conversation around the culture of risk and the proactive risk function that Tyler, you've really fostered there at Service. And it's great to have you back here today. We're going to dig in a little bit in more detail into the risk appetite statement, which you introduced during the last conversation. So thanks for being with us.
Yeah, absolutely. I look forward to it. Thanks for having me back.
So as I said, during our last conversation, we discussed the culture of risk, right, that's evolving there at Service Credit Union. And specifically, we talked about themes such as the importance of open communication and proactive engagement. I think you used some great lines around staying relevant and really wanting to help the organization take measurable approaches to risk and getting buy-in across the team, and how all those things contributed to this culture. So to this end, right, one of the things we talked about towards the tail end of our discussion was having a robust risk appetite statement to serve as Service Credit Union's North Star, and how that's been key to establishing the strong culture of risk. And I'd like to unpack that a little bit more here today. So yeah, you'd mentioned that Service Credit Union's risk appetite statement was crafted 4 years ago. You said you review it annually, and it's experienced a few tweaks on the margin, but essentially it's endured originally as written to this day, which is impressive considering, right, the dynamic financial institution world in which we operate. One of the benefits for this consistency is that you're able to provide a clear, consistent target to stakeholders, right? You talked about engaging stakeholders across the organization, from the CEO to the board of directors, to the risk committee, to the business line leaders. And you've been able to set this direction and progress forward continuously without major shifts in direction, which really would have slowed you down and potentially derailed your journey. So let's go back to the beginning. Let's start by what you saw when you walked in the door, and then we'll kind of take it from there. So when you walked in the door, was there a risk appetite statement? What did it look like, and why did it need to change?
Yeah, we did have one. It was done in 2015. I had to kind of dig back in the archives. Fortunately, they go back that far. Right. But it wasn't bad. It was based off of the guidance at the time through COSO and RIMS and that kind of guidance. But there, I wasn't a part of the process, so I was kind of like digging through and looking. But we definitely did change it when I came on board and kind of started to shepherd the program a little bit. But it wasn't bad, right? It had a couple similar characteristics. So things that ours have is things that are consistent with your risk appetite, things that are inconsistent. It actually did have that. It was a little, for me personally, it was a little broad. I think it was one of those areas where if we paint a broad brush, we can kind of make things fit in there. But there was a few, that was with most of the statements. Some of the inconsistent type statements that it had, like an example, it actually did have compliance risk. And like an example of inconsistent was acts that willfully neglect to abide by or understand laws, regulatory conditions. Like, yeah, I mean, no one wants to violate laws, but those things are always to me are kind of like table stakes, right? We're a financial institution. I don't think anyone wakes up in the morning and is like, man, I'm going to violate the law today. That's like table stakes. I think you got to refine it a little bit past that, but there's some other stuff in there that's good, right? I don't want to take away from what the previous appetite statement was. I just thought it needed refinement.
All right. You chose to rewrite it rather than simply refresh it. I know that maybe that some might say that's a distinction without a difference, but I think that there's something to dig into a little bit there. And why did you rewrite it, and what was right? You talked a little bit about your objectives there, right? Maybe moving beyond the table stakes, but why kind of go one direction versus the other there?
It kind of goes back to the last session we talked about with buy-in, right? If you can facilitate that process, especially if you're newer in your role, you're just coming to the organization, it doesn't always mean you have to rewrite it, but you at least have to revisit it and go through the process with the stakeholders, right? Especially the board. I was in a unique position where our CEO was fairly new. just coming on board, and I was put into this role as a part of that. I still was a part of the organization, but it was a new role for me within the organization. And I think the benefit was twofold, right? From a CEO perspective and his perspective, it was a really strong play for him to understand the board appetite and kind of how to navigate that, right? Like, he was coming into our environment as an outside party, and he was able to understand the board appetite, the management appetite. So I think it was really smart. He definitely encouraged me to do it. There was a lot of buy-in there, and I've talked about his support in the previous podcast as well. But that was significant. But ultimately, for me, it was validation around, I want to see this process through and see where we land, right? And kind of help do it. We use a consultant, right, as well, to kind of help us through the process, because it was fairly new role for me. So that was important. But really, it started with getting buy-in and looking at the landscape and saying, this is the best way to obtain buy-in. When we get through this process, they're going to be all in. We're going to have the board aligned. We're going to have management aligned. And the CEO ultimately is supportive of that. So that really set the landscape for us and made it a no-brainer.
So let's go through a little bit of that process itself. All right. I understand, right? This was a new chair for you. And so the idea of having someone, assist with that process, that it's not their first rodeo, right? That sounds really valuable, and they can bring some ideas and best practices to the table. How did you choose the right partner to go on that journey with?
Yeah, I think in the credit union space, one of the things that I've always loved about it, we're very collaborative. But ultimately, right, it's reference checks. That's what it comes down to, and it's finding partners that others have had success with, and getting a level of confidence in, right, reaching out to your network and saying, hey, like, who helped you out here, and did you like the results, right? And the other thing is, right, it's not just did you like the results, but did it stick, right? Did you get buy-in? Were you able to help build a program off of those appetite statements? If so, I mean, it's a great candidate. So it's really leaning on the references and making sure that you feel confident about the vendor you're about to bring in.
All right, you find the right partner, right? Well, you find some partners, you could do your reference checks, you then find the right partner and say, all right, we're gonna get after this together. You make a decision to go down that path. You work with them. Take us a little bit through that journey. How long did it take for you to work with them to get something that you felt really good about? And then what happened next? Once you had that in hand, where do you go from there?
Yeah, I want to say it took us probably 3 to 6 months is my guess, in total. And the other thing I'll mention, and this might have been part of your prior question that I maybe brushed over, was like, why work with a partner, right? And I think it's really important when we brought someone in, again, like, they have the knowledge, the expertise, but they walked us through, I think our questionnaire that we went through was maybe like 120, 140 questions. It was like pretty in depth. It's a lot of information, right? Because you're trying to evaluate where everyone's at, and doing that work yourself is really overwhelming. You're also trying to kind of stand up a program, get your feet wet. So that was really, really important. But I'd say, 3 to 6 months to stand it up. A lot of it is getting the questionnaires and the surveys out. In our case, we did it to the board and our senior management team. So getting an understanding of where they perceive risk in the organization. So there was kind of a two-part survey. One was where you perceive we are at today. And there was a lot of questions around situational questions, like how do you perceive, right, a new checking product or a new product line or something like that. And what are the risks you're willing to take with that? So there was a lot of situational type questions, understanding where you're at today. But then there was also stuff about, well, what's your appetite like, right? Because sometimes we operate in this environment as we perceive the environment to be. And the reality is that we're actually willing to take on more. But the reason we don't is because of our peers or our board or our CEO, right? So those excuses. So where do you want to be and where do you think you're at today? So that's what was the results that we got through the survey process.
All right. So you go through that survey process. You allow people to perhaps remove some of the constraints, and find out really what are their guideposts as opposed to what are the guideposts that perhaps they perceive the organization is imposing on them, right? So by bringing in that third party, you've helped to kind of neutralize that dynamic. And you get to the end of those 3 to 6 months, you've got this feedback from the board, from management. and you've got some overlay from the advisor there. What happened at that point?
Yeah, it's a multi-step process. It started with a readout of the results, right? Which was really interesting. So you're going through and they essentially demonstrate, here's, where everyone's at today, and they would separate it by management and board. And it was interesting because, right, here's how the board perceives you're operating today. Here's how you perceive you're operating today. And there's a difference, right? And then when we think about where the risk appetite should be, there was a difference as well. And it was pretty significant, right? And it's really interesting to see those results, but you don't just leave it there. You really have to dig in on those. So they would take kind of key themes based on the results of some of the bigger disparities. And what you actually find out is there was sometimes where, based on the way that was worded or our past experiences, right? They have so much to do with how we perceive things in our organization. In the example I gave of like a new checking product or whatever, someone on the board had a really bad experience with a previous product rollout. It was like, it needs to be perfect, right? But as we really dug into it and said, all right, well, different management team, different procedures, different players now, like, how do you feel, right? Like, it doesn't change the outcome. You want the same outcome and you want that to be protected, but are you willing to take a little bit more risk with the team that you have here today? And we kind of find that middle ground. And it really helped to kind of bring the two sides together and say, yeah, you know what, like, we can take a little more, and the board is supportive of that, right? And when you go through and you start having those discussions, it becomes really powerful to shake out the differences, because ultimately you need alignment, right? And it's just like anything related to strategy or anything else, right? You need alignment from the team, and we can, behind closed doors, disagree on something, but then we need to be able to voice our concerns, feel like we're heard. And then when we leave that room, even if I still might disagree, I'm behind the team and supportive, right? Because you ultimately need to support and work like a team. The risk appetite statements have to work the same way. You've got to be supportive of it, come to consensus. And that was the process that we went through next, is really reconciling those differences and understanding, what does this statement look like when we come together and agree on it.
All right, you've achieved a level of alignment there, right? Whether it was consensus or input from all over the map, but right, however you get to that point, you get to that and say, all right, you know what, this is it, we're on board, we're all charging, down this path together. And you, as you said, I think I like that phrase, right? Once you exit that room, you've all got to be aligned. You've all got to be, move in the same direction. How do you then maintain that risk appetite statement? I mean, one of the things that you talked about was how long it had really endured. So what do you do to maintain it, or are there some characteristics of it that have allowed it to persist so, for such a, long period of time, so robustly?
Yeah, absolutely. It's almost a little bit embarrassing to kind of say that they've stood the test of time for 4 years, right? Things have changed. Like, think of 4 years ago, COVID wasn't even a thing, right? Like, the world has changed drastically.
Yeah.
So it's a little scary to admit that, but I think for us, the key to success is, when we sat down in a room and started going through the drafts of the risk appetite statements, it started to grow, right? Like, so the paragraphs that we have, so the way that ours are structured is we essentially have a statement for each area, and ours are kind of aligned with the CAMEL ratings. So we have like compliance, credit, interest rate, strategic. We added a net new one for information security and technology risk, just given the evolution of that landscape. But we have 3 main components. We have the bulk of the statement that says, what our appetite is, and it's typically like a low, medium, high, that using that type of terminology. And then we go through into a number of statements as far as what that looks like kind of operationally, strategically. And then we have a section after that says actions consistent with and actions inconsistent with the risk appetite. And I think what's allowed it to stand the test of time is you're detailed enough in kind of all 3 of those sections where you're not calling out anything specific, but it gives you guideposts to work within, right? So I'll give you an example, because I already picked on the compliance risk statement. So one of ours that's consistent with risk appetite is be open to taking supportable, aggressive stances on regulations to produce member benefits and push innovation. The reason that stands the test of time is because compliance doesn't move all that fast, right? Like, there'll be some new rules here and there. CFPB is trying to change that a little bit. Outside of that, it doesn't move super fast. But when we think about what we want to do strategically, it always for us is a member benefit. right? And how we want to grow our organization is really on that member benefit. And we also want to be innovative, right? We don't want to sit here on our laurels and just say, you know, we hope to be the same in 10 years. That's not the case. So that allows us to take that and say, you know what, we'll push the needle a little bit, but we have to be able to support it, right? We've got to do the research, do the work, be able to support and defend your position. And I can give examples. I won't, because it gets a little bit more into the weeds, but where we've actually had conscious discussions on that line alone, where we've done some stuff on the innovation front in our investments in with fintechs and that type of work, where we kind of said, like, there's not really, we heard things from regulators that said they're supportive of what we were doing and a couple others in the industry, but it hadn't been concretely kind of put into any sort of regulatory framework. So we are in this void, in this gray area where, like, verbally we have support, they're making statements, but there's nothing on paper that supports that, right? So there's this gap, and that statement allowed us to feel comfortable about, you know what, like, this is going to be okay. And we actually didn't have to, like, come down and say, well, let's go back to the risk appetite statement. This is just part of our culture. So we try to get our culture in our risk appetite statements and say, this is how we want to do business. And the CEO and the management team have built up a group that believes in doing business that way. So that's really what it's allowed us to stand the test of time. And I have a few other examples too that we can walk through.
Yeah, I like that, because you're reinforcing the fact that this has just become inherent. This is in your DNA. This is who you are. And so you don't need to necessarily go back to it. You will if there's a question. But it's just how people behave now at this point in time. And right, in your example, yeah, right, you talk about the emergence of fintechs on the scene, and you can say, all right, well, you now have this lens, all right? Is this, I've got an example of consistent or inconsistent, right? Where does this fall, right? Does this drive a member benefit? Is this innovative, right? Why are we doing this? And it's specific enough, but also gives you enough of a wide enough berth to progress with over time as well.
Yeah, absolutely.
You said you might have another example or two. Do you want to share another example with us?
Yeah, so I mentioned the CFPB earlier, and there's a lot of talk around junk fees and fee structures and all of that. So I'll kind of pick on that one, because again, that's a pretty new development. Like, we've always talked about fees, right? We kind of probably saw it coming, but the aggressiveness in which we're pursuing, or regulators are pursuing junk fees, and that terminology has really, really bubbled to the surface, especially kind of coming into 2024. So again, these risk appetite statements were, this one that I'll kind of share and read from was developed in 2020. All right, so before junk fee was really on the docket.
Yeah.
One of the things that so reputation risk for us, we've always thought about fees and the structure and presentation of fees, right? It's important to your reputation risk. So inconsistent with risk appetite for us in our organization is use fees aggressively to push members to desired behaviors, right? So we don't want to use fees to really influence behavior aggressively. One of the things when the CFPB was coming out, we started doing a lot of, or not coming out, but was talking about junk fees, right? We started to do a lot of analysis on NSF. And for us, we offer a product called Courtesy Pay, which is essentially like your overdraft protection, right? And it's opt-in and everything else. And what's interesting about that is we looked at our fee and we looked at reducing it and did some calculations. All right, we know we're going to forfeit some fee income, but we started to talk to some peers in the industry that, and we know some that have dropped to $5 fees on overdraft protection, that type of stuff. And what we heard was there's definitely a revenue hit to that, but on the flip side, there was also a significant increase in usage, right? And one of the things that we tried to be conscious again of, like, for us, member financial well-being is one of, like, our guiding stars, right? And we didn't feel comfortable just, like, hammering our fee down, not because of the revenue implications. Like, that came up, but it was like, once the analysis was presented, it was over. Like, we were good with it, right? Like, you understand that very easily because you can quantify it. It's not difficult. But when we started thinking about the member impact, and actually we had a group of individuals start calling our high use members. So the people that reliably use and use it the most, and start to kind of ask them and understand, like, what would this mean for you if we dropped the fee, or if we took it away, or these other type of things. And there's people that rely on it, right? And they use it and they're happy with it. It's a service that they pay for. I think NSF is probably a little bit different, right? But especially these opt-in fees. So using this, again, like from a cultural standpoint, we didn't have to revisit the statement. It was part of the culture, right? And we're having the appetite statement really like that, things that are consistent and inconsistent, right? We have a line in our consistent for that also says like, be clear and honest about fees while being fair to members, right? So like transparency is important, right?
Yeah.
But make sure that we're doing the right thing for our member. And this really helps speak to that. And as we went through that analysis and went through those discussions, we ended up not landing on dropping into 5. Right now, what we've been doing is every year we shave 5 off, and we're measuring the impact of that. Because what we're trying to do is essentially find the sweet spot where, yeah, we're getting less revenue, but we're also not driving up usage. We want to start to essentially like stay somewhat level where we're not encouraging the use of something that is not good for your financial well-being.
Right. You said earlier, right? It's about, member benefit and driving positive behavior there. And so because you've got those themes in there, it allows you to look at that and say, well, look, if we're just looking at this to, eliminate a cost to them, that's one thing, but is that going to then drive behavior that is not necessarily in their long-term interest? And so that's a statement that has clearly stood the test of time, is applied in this specific example today, even though it wasn't necessarily authored with this example in mind.
Yeah, exactly. Yep.
One more? Do you have one more in there?
As far as examples, let's see. I mean, so strategic, I think, is a good one. Strategic is one of our higher appetites, right? I mean, that's where we're gonna move the needle, is making sure that we have alignment on strategy. A couple of the buzzwords. So I'm going to get away from consistent and inconsistent risk appetites and kind of lean on the statement that we have. And some of that, right? Like, you balance things out. So it's kind of like when we do performance evaluations, you might be really good here. This is your strength. And we kind of meet in the middle there so that we're not dinging you or giving you too much. I use that as a joke, but ultimately for strategic, right? Like you kind of use, hey, we have a pretty high appetite, but these are the things that we're willing to take some risk on. And then these are things that like we're less going to take risk on, and it balances out in the middle. So one of the statements that we have in our paragraph is, we have a relatively high appetite for investing modest amounts of capital in new ventures and mergers in pursuit of future benefits, pursuing digital transformation and emerging technology, delegating responsibility to managers, dropping or modifying select products and services that operate with losses, pursuing new members from competitors, and branching out to serve many different groups of members. It's long, it's lengthy, but it's broad enough, but also specific enough, right? And hopefully get kind of that flavor where it's like, yeah, we're gonna take some capital, we're gonna reinvest it. Right? Like you don't hear a lot about, we're going to, aggressively pursue merger opportunities.
Right.
So like, it's where do we want to invest our capital and our resources, and making sure that we delegate things to authority. We don't want to have a micromanagement type culture, right? So what are all these things at a high level? Give us the guideposts to say, when we go into strategic planning, these are things that we want to pursue. And since this was written, like one of the things that we've been pretty aggressive on is trying to kind of create a better digital experience, like a lot of people, but also investing our technology early. So when we came out with this, we went through a core conversion, we onboarded CRM, we changed a lot of the technology we were using as an organization to look ahead and say, this is going to put us in a position for future growth. Right. So kind of taking a step back in order to take 3 steps forward was really the goal, and our appetite statements aligned with that activity to say, we need to invest in the technology today. It's going to take some time. We can't pursue other things as a result of that. But by doing it, it's going to put us in a position to reinvest our capital, take advantage of fintech partners, right? Have APIs that we can leverage versus the legacy core, right? Start to do integrations and start to create ultimately a better end user and member experience for us.
Thank you for that. I mean, I think that the getting the specifics really just helps people kind of put a pin in it and say, all right, this is, you move beyond the conceptual into the practical there. You've shared quite a bit here around your journey. Maybe my closing question here is, are there any lessons learned, right? You shared a few things along the way around, right, how to find the right partner and lean into your network and do the reference checks. And and compare and contrast, right? Perceive what are the perceptions of risk today versus for the future, and making sure everyone reaches alignment there between management and the board. And then we got into some specific examples. Are there any other lessons learned from this process that you'd like to share with folks?
Yeah, the one other recommendation I would have is be intentional about the results you expect out of the process, right? So before you even go into this, everyone creates an ERM program. They create it for a reason. A lot of times the reason might be regulators, or that's usually where it is, like the prompting from the regulators. If it's not your reason for creating the ERM program, like, good on your organization, and you probably have a really good culture there to kind of be looking at this stuff ahead before the regulators are kind of requiring it. But I think understanding what you want to accomplish out of it, right? If your MO is to say, we need a risk appetite statement, we got to go through all this because the regulators are asking us to. I just don't think programs like that can succeed. You'll check the box, don't get me wrong. And if the box is success for you, I actually can't criticize you, because, right, you said exactly what you want to accomplish, and you set out and you accomplished it, right? So that's good. But be really intentional about what you want to accomplish. If you want your ERM program to really drive strategy and help, not like drive it, but be involved in it and be a core and key player in strategic decision making, and in making sure that the organization is aligned around something, right? And I think that's really where ERM can play a significant role. Otherwise, right, we can all align around strategy, but then strategy changes, right? Aligning around risk appetite statements and aligning around an ERM program says we are all in agreement as to how we want to accomplish success. The metrics around success may change, the strategies around success may change, but ultimately we know there's alignment in how we're going to manage and what we're managing to.
And look, if you do that, if you put in the work up front, you create something that the organization really coalesces around. It becomes part of your culture, right? You mentioned it earlier. Oftentimes, you don't even need to go back and look at that risk appetite statement, because it's just who you are. It has become what your organization is. And so I think that's a really powerful message about being intentional about the results you're seeking to accomplish, and then that will lead to a better experience and a better outcome as well.
Absolutely.
Tyler, thank you. We appreciate all the thoughts here today. Thanks for being with us again. Great insights, and really helpful to folks who are about to embark upon that journey of either creating a risk appetite statement for the first time, or potentially relooking and refreshing or rewriting one. So thanks for sharing your thoughts.
Absolutely. Thanks.
All right, take care.